Will be on a couple of these themes as we kickstart a brand new day of trade. Last trading day of the week, and there we have it, 21,286 on the Nifty, a big bang opening, almost 100 points. Remember, this is on the back of that big rally we saw yesterday, so a solid start for the market, building on to its gain second day in a row, and the Sensex as well up about 280 odd points. What's leading from the front this morning is autos. M&M, Hero MotoCorp are your top gainers, Maruti Suzuki as well. Hero, of course, has that additional news flow on buying more stake in Ether, so the street likes that. Valuations are also reasonable. IT is the other space that's been doing quite well lately, so Infosys is your top gainer, up 1.5% as we speak. Tata Steel, JSW Steel, so the metal space is also looking pretty good this morning, contributing to the up move. Now the indices gains are, it's about 80, 85 points. It's settling over there. We're used to a lot more in the last couple of days. This looks mild, but it's a very good start. No two ways about that. Bank Nifty is also leading from the front. On the downside, though, you have few and far between Bharti Airtel, HDFC Life, BPCL, just stocks that are tad bit soft. Otherwise, it's a very strong opening. Now advancing to almost a 100-point gain on the Nifty. The Sensex is up over 300 points.
Well, that's right. Let's take a look at a few stocks on the broader markets, though, are calling for attention. KFIN, we had that large trade that took place, so that's down close on 6.5%. I don't think I've got a chance to say this in a while, at market opening, but IRDA is down closer around 3%. Normally, that stock has just been moving one direction from listing. It's up more than 3 times, but today it's pulling back a little bit. Let's see how long that lasts. On the flip side, you have Texmac or Rail post that order bin. That's doing very, very well. In fact, the rail and rail-related plays are doing pretty well today. I think Jupiter Wagons as well was up. IRFC was higher in trade. IRCON is up close to around 2.5%. These are some of the top traded volume stocks. PSU as well as metal stocks. If we have that combination, then that's doing pretty well as well. NALCO is doing well yet again. NMDC Steel is up close to around 3%. Remember, the stock had corrected from around 60 rupees all the way to around 40 rupees. But NMDC Steel has moved up today. And NBCC as well, post that order bin, that's moving up close to around 2% out.
All right. Well, it's a it's a good start once again. We're used to good starts, aren't we? I mean, almost 0.5%, 21,270 is where the index is trading at this point in time. Let's just look at the Nifty Bank as well. And then we'll kind of invite in our next guest on the program. Maybe just a... sorry, Sonia.
No, we kind of felt like, spoiled for choice, right? That dopamine rush that we get because of such big gains. I mean, now if it's like less than 0.5%...
it's not
like,
even 100 points on the Nifty.
It's not such a great day, guys. It's just opening flat. But, I mean, it's all about the dopamine, I guess.
You're making us sound like lab rats. Reacting to stimuli.
Lab bulls, maybe.
Well, but it's a great start once again. Absolutely no two ways about it. Just a quick... look at a few other stocks before we go any further. IRFC should come up, but we're about 5.5% higher. It's got huge volumes. I think we mentioned NALCO, which is up about 3.5%. Texmaco, Titagarh, etc., 8% and 4% respectively. Jupiter Wagons, actually this entire railway rolling stock theme, I mean, that's doing extremely well. Amber is up 4%. Amber comes in at about 32.30. Sterling, Wilson and Solar, I mean, that QYP I think has gotten done. 435 on Sterling Wilson. Shipping Corporation of India is coming up with a 6% gain, only mentioning things with the largest volumes. Piramal Enterprises is up about 2.25% as well. And then I'll kind of not go down the list. There's a lot, but volumes are still picking up. So maybe in a bit, we'll revisit more stuff which is going on. KFIN is, of course, that block. IRDA, IREDA, 6.5% lower. Humongous volumes, of course, a little pull. This is a 7% drop would qualify as a little pullback because the gains have been so humongous. And HPCL is starting HPCL and BPCL, both are starting a little lower at this point in time. Shriram Finance was a big mover, 6%, that's pulling back. And then you've got Prestige Estates, which is down about 2% or so as well. So that's what you have in terms of gains. Saurabh Mukherjee is our market master today. He's founder at Marshall's Investment Managers. He's with us here in our studios. Saurabh, great to have you with us here. Thank you for your time.
Thank you for inviting me.
I mean, it's looking blue sky and bluest skies. So it's kind of... Sometimes I just get a little, not scared, but are we taking too much away from the future, or this is okay? I mean, what's what we're seeing?
Look, if you look at it, the large cap piece, I wouldn't say we're taking too much away. Large cap is up 14-15% YOY, and in a country where earnings growth is running in the mid to high teens for most large cap companies, I don't think there's that much cause to worry about large caps. It's the small cap piece, which is a little scary. There are hundreds of stocks which have doubled, trebled in the last couple of years. I think that's where there is a bit of a challenge. In any stock market, overvaluation will take care of itself. I think what we are looking forward to in large caps is with the Fed hikes out of the way, with lack of political visibility out of the way. I think we can look forward to at least a year, hopefully a couple of years of solid share price action in large caps. The economy is solid, earnings compounding is mid to high teens for good companies, and we're looking forward to that over the next couple of years. We're already seeing in terms of foreign investor inquiries, now that the political clarity piece in India is established and the Fed clarity is established, we're already seeing pick up in foreign visitors coming through India. These are foreign investors, sovereign wealth funds, pension funds coming through India. And I reckon 2024, Prashant, will be a year of somewhere between $20 to $40 billion of foreign inflows.
Do you, by the way, I'm just asking this because we are at that point in the year when maybe allocations, etc., for next year get decided and money starts coming in next year. I mean, do you manage foreign? Would you take those kind of mandates as well? I mean,
so we do that, and as you're rightly alluding to, we are seeing those come through, and we're in the process of setting up some of the accounts, and some of the other accounts we're in the final stages of discussing with the investors whether we get the mandate or somebody else does. But regardless of whether we get the mandate or somebody else does, it is very clear that we will see a decisive uptick in foreign investor inflows next year. This year, I think the country, over the course of the last 12 months, the calendar year, India would have done $5-7 billion. I reckon next year is something like 5 to 10x this number that's going to come in.
Okay, well, the market's continuing to move upwards, so don't, get your eye off the headline index. 21,300 is almost here. Look at the pace at which the market is rallied. Saurabh, thanks for joining us. So if you believe that large caps is the place to be, what are the pockets to look at? Do you think IT will come back in a big way? Because the street is still divided on that front.
So I think three pockets where there are well-run companies, and those companies can, their market caps can take a lot of money. The first obvious one is private sector banks. They're obviously doing very well from the ongoing economic recovery. Their share prices haven't done much over the last couple of years, and I think that's an obvious area where we will see heavy foreign inflows. The second is IT services. If the Western economies start turning the corner next year on macro, then those big order books, the bulging order books that the Indian IT services have, those will get translated into business. So over the last 2 to 3 quarters, the Indian IT companies have been very clear that they've got big order books, but the client is not pressing the green button on execution. I suspect some of those green buttons will start getting pressed on execution. And the third is private sector capex. Right? In the last 4 years, government capex has almost tripled in India. Private sector capex has hardly grown in the last 4 years. I think that piece revs into high gear, and we are looking for companies that we can identify to play the private sector capex piece.
Okay, all right. Hi, Saurabh. Good to see you in the studio as well. The last time we chatted, you spoke about a couple of stocks. HDFC Bank, which has been an underperformer. Looks like in the last 1 month, it's finding its form. So pretty good news. And Trent, I think, is the other one that we spoke as well. And that's done pretty well. But before we get chatting about sectors as well as stocks, I wanted to ask you, what's the client behavior? Are you seeing any kind of redemptions? Are flows as strong for the money that you're managing?
So in the local piece, we've seen outflows given our style of investing. And as you're alluding to, stocks like HDFC Bank haven't done much. On the local piece, we've seen outflows over the last 7 months. Thankfully, the product, our investment performance has gone up. So the two have netted out. On the foreign investor fees, we've seen steady inflows over the last couple of years. So the foreign investor and the domestic investor behave a little differently. The domestic investor likes to play the bull market upswing. Okay. The foreign investor likes to be the patient long-term investor who's happy to load up, say, on a Asian Paints or an HDFC Bank or a Kotak Bank or a Bajaj Finance and play for 5-10 years. So our domestic investor flows have been negative for the last 6 months. But because the flagship product is up 25% in the last 7 months, that's sort of figured out. And we're therefore left with the main source of inflows being for us, the foreign investor over the last couple of years.
Okay, all right. How have you all changed your portfolio, in the last couple of months or so? Any position that you all have added on to? I think HDFC Bank is something that you said you all have consistently been adding on to. Yeah. But anything fresh that you all have done in terms of adding a position or even, lightening a position somewhere?
So I think the piece where we're getting incremental good news is the worst of the Chinese dumping in specialty chemicals seems to be behind us. Over the last 6 weeks or so, for the first time in 2 years, I'm seeing some of the specialty chemical prices rise. So over the last 3 months, we've built a position in Clean Science. It's a company we've been looking at for a while, but now that the scare around actually it wasn't a scare, it was a real thing. Between May to October, China cut prices of specialty chemicals by 25%. With that hopefully behind us, a team from China returned yesterday, and the sense is that the worst of the Chinese dumping is behind us. We've built a position in Clean Science. We like what they have done in what's called hindered amines light stabilizers. This is a very high-end chemical. It's never been made before in India, and hopefully Clean Science can build a world-leading franchise there. We've historically been big fans of the diagnostic space. Dr. Lal Path Labs, Metropolis, Vijay Diagnostics, these sit in various Marcellus portfolios. Over the last 3-4 months, we've also developed a liking for hospitals. So we've built a position in Rainbow Hospital. It's a Hyderabad-based pediatric and maternity care chain, 1,700 beds spread across various cities in South India. But I think this is a broader theme. As Indians get more affluent, as health insurance becomes more embedded in our lives, I think the private sector hospital space is looking very interesting for us.
That's an impressive hospital as well. I visited it.
Right.
We had done a special show on CNBC-TV18 as well.
Just one follow-up. You said that you're looking to the private sector capex area as well, right? I mean, L&T, of course, has been a big mover this year, but what else? Where else do you see potential despite the rally that we've seen?
So we haven't got Cummins, but I wish we had. I think Cummins remains a singular play on the genset space. It's an unchallenged player in gensets in our country, especially the larger gensets. See, what's also happening, if you just join the dots, every week 3 to 4 global capability centers are opening in India. The only genset which can fire up a GCC as a backup is the Cummins genset. Similarly, factories are coming up, hotels are coming up, new office buildings are coming up, and almost by default, these buildings, this construction capex needs a Cummins genset. So I think that's an area where it's a well-known company, it's a world-leading company, no great secrets here. So that should be a default play on the private sector capex story. Beyond that, in small and mid-cap, there are several interesting Indian light industrial manufacturers who will do really well on the back of a capex boom. We're trying to pick and choose our spots, because it's also it's relatively clear that there will be FDI. European and American industrial companies are going to come to India. They're going to acquire players in India, and they'll try to become part of the Indian landscape. We're the only part of the world where steel consumption is growing at, it's hard to believe, but steel consumption is growing at 19% as per the latest capex data. So we will see foreign companies coming to India, setting up or acquiring smaller Indian businesses and revving up competitive intensity.
In real estate, Saurabh, what's your exposure? I mean, how do you
So we don't invest in real estate developers per se, because as I've historically said, barriers to entry remain reasonably shallow. What we do is plenty of investing in building materials, right? So Pidilite, Asian Paints in the large cap portfolio, inconsistent compounders, Astral Poly in our mid cap portfolio. Actually, Astral Poly is also now in our large cap portfolio as well. Serra Sanitary Ware in our small cap portfolio. We did a trip last week to Gujarat to understand the building materials boom. And I reckon we got 3 years of straightforward runway on pipes, paints, tiles, sanitary ware, because of the boom in affordable housing. These are houses, say, to 10 lakhs to 15 lakhs ticket size real estate developments. That's an enormous boom. It's got PMAY money behind it. It's got mortgage finance from the Aavasas and the Home Firsts behind it. And that boom, I think, lasts several years. That will fire up the building materials, further fire up the building materials play.
Although even on real estate builders, and by the way, we have a real estate company joining us next after this conversation, there's been consolidation towards quality builders, right?
There has been, yeah.
So doesn't that kind of bode
The challenge is what happens in the next bull run, which is what we are living through. You once again see entry, and once again you see dilution of rookies. So in fact, I was already speaking to some of the smaller developers in Gujarat, and I was asking them about their IRRs that they get on residential real estate, and already the IRRs on resi real estate are on the way down in the less organized markets of Gujarat. Remember, Bombay is a more organized market, and therefore entry for a new developer is harder. But in less organized markets, already you're seeing new entry, which is putting pressure on the returns that developers get. So such is the cycle of free markets. It's a good thing. That's how it should be. When you have a sector doing well, it invites new entry. If the barriers to entry are shallow, Prashant, then the incumbents' return ratios get pushed down. The ironic thing, the reason we like building materials is it's much harder. It's much harder to enter, say, sanitary ware and take on Cera. It's much harder to enter CPVC pipes and take on Astral and so on and so forth. And hence, the building material seems to us to be a more structurally solid way to play what looks to be a pretty long boom in construction in our country.
All right.
Just a quick disclaimer, all of these stocks, I have them. My parents are our clients, so they have them in our portfolio, and 9,000 domestic and foreign investors have these stocks in their portfolios.
Well, thanks very much, Saurabh. Great to have you with us here.
Much.
It's a pleasure speaking with you here on CNBC-TV18. Actually, Saurabh, if you want to stay on and listen to the next conversation, that's an interesting one. Prestige Estates is the company we're speaking with. It's been one of the big winners of 2023. Stock has seen a stellar move. It's up 150% nearly this year. Mr. Irfan Razak is with us, Chairman and Managing Director at Prestige Group. Mr. Razak, great to have you with us here, sir. Thank you very much for your time. I mean, it's been amazing, and if one has been a Prestige shareholder, one is feeling prestigious, one is feeling happy. So you heard Saurabh is here, and he's listening in as well. Just comment on that a little bit. The accepted wisdom in a way is that we're in perhaps year 2 or year 3 or what will be a 7-8 year kind of upcycle for real estate, for the real estate market per se. Just comment on that first, and then some of the points that Saurabh made, if you were listening in, sir. Go on.
Yeah, good morning, Prashant. Actually, it's quite an interesting conversation you had with Saurabh. Yes, the real estate investments, home buying is here to stay. I would always say it's the tip of the iceberg. And like he said, it fires up the entire ancillary industry, the support industry that is there supporting real estate. And that is, if you look at it, it is every material conceivable for, I think we support almost 230 odd of these industries. And that's where the good news is. And it's just the beginning. I mean, there's housing, urbanization is happening very rapidly. People need homes. We need to build more and more homes. Yes, in which category is the question? And I mean, the obvious answer is we need to cater to the bottom of the pyramid, while we also are doing luxury and premium homes. So it's a mixed bag that we have to be on, and that will be the winner. And the volumes will come from the mid-income housing.
Mr. Razak, good morning, and Happy New Year in advance to you and your team at Prestige. Now that we're entering into perhaps what could be a long rate cutting cycle, it could begin with the Fed, the RBI could take it forward as well. Do you think that the demand will go up for real estate inventory and for houses compared to what we saw in the rate hiking cycle, or is that just on paper? I mean, does it really happen? Does it really play out like that? And what is your expectation for the full year?
No, I see it's a feel-good factor. See, when the rates did go up, everybody was having that fear that people will stop buying, but that didn't happen. But the thing is, if the rates don't go up either too much or go down too much, I mean, there is a feel-good factor. Obviously, if there's a rate cut, there is the cheer, and there'll be that many more commitments that will happen. And what it does really is, if there's a rate cut, it gives that much more sort of money in the pocket for the home loan for the home buyer, so they really can buy a slightly more expensive house. Because today everyone is looking for that one extra room in their apartment, and that is what is also helping us in the sense this work from home culture, some space for themselves. So that realization has come. And I think a rate cut will definitely help in us selling a slightly more larger or bigger product.
All right. Hi, Mr. Razak. Good morning. Thanks so much for joining in. Nigel on this side. Well, tell us what percentage of your sales come in from new sales and how much of it is coming in from the old inventory?
No, that's an amazing question, because today all our old inventory is almost sold out. So we hardly have any old inventory, and whatever is coming only from new launches. That is why there's a huge dependency on keeping on launching new product. And the quarter that we don't have a big launch, that quarter we have a little bit of a slowdown in the overall top line revenue. Having said that, now we've been launching quarter on quarter a lot of product, different cities. and that's helped us to sort of pump up our top line. Like now in Mumbai, I'm waiting for my Ocean Towers, the RERA number, which is likely to come today. Once it comes in hand today, we were hoping to get it much earlier, but then, okay, if it comes today, hopefully in the next 15 days, we'll notch up a lot of top line revenue. Similarly, we did a big launch in Hyderabad in the beginning of November, and that also helped us get a huge revenue. So this quarter was dependent on Hyderabad, Mumbai, Bangalore. We did a small launch, and then see now we hardly have inventory in Bangalore. And whatever the good news is, whatever we are launching, it's getting completed. It's just there's nothing left over. So then there's that much more pressure for us to see that the new inventory comes in and we get the revenue.
So you're targeting 20,000 crores of sales in FY24. What would it be like in FY25? What could the reasonable growth be?
I see when we did that 13,000 in FY22, I gave a target of about a growth between 20-25% on that. And now the good news is we inshallah we should reach, and we will reach that 20K mark for this financial year, that is FY24. Going forward, yes, the teams are working hard in different geographies, seeing that, you see, it's all production. Basically, it's planning, approval, all of it, and there's a phasing out bringing in the product into the market at the right time. So with this sort of push, and if everything goes well in terms of getting the RERA, getting the approvals in time, I'm sure FY25 will also have a growth of about 25% on the existing base, because the base is getting larger. I don't think we'll slip behind, but I'm very confident. I'm very positive that there will be growth on that large base.
So, Razak, what you seem to be telling us is that the only constraint is, approvals. Not a constraint, but how fast you can get approvals. That's about it, right? Because that's how fast you're able to sell these projects as you launch them. Sorry, you want to come in, sir?
Material, it's the raw material. See, for me, raw material is land. And I need to see that I have the right type of location, the right type of land. The teams have to work, conceive the drawings, conceive the plans, and then get all the approvals. There are lots of approvals that you need to get to the final approval. So, right from your fire and environment and everything else. So it's a big work, a big job that we have to do. And it takes about at least a minimum of a year from the time we start conceiving a project to bring it to the market. So that's the type of level of work. And that 1 year I'm saying is the minimum time, not the maximum time. So that's how it is. But I think our team has really got the art of doing it well. And we seem to have sort of mastered that. And that's how we are able to bring in more and more product into the market. So once it comes in, we are very confident there is a demand and people are buying.
Mr. Razak, I just wanted your thoughts on it. I mean, I don't think there's a definitive answer with anyone, but how much is the real estate cycle dependent on the stock market cycle, in your opinion? Because I mean, the one thing which is which is just a big boom going on, right, in stocks and equities. There's the wealth effect impact as well, which is well understood the world over, not just here. So, is it kind of sort of one feeding into the other? Your thoughts on it?
It's just not the stock market. One thing is they're not related to each other, but like you really said, is the wealth effect. It's just not the stock market. It's the general share. It's the economy itself. It's the business itself, and people are into money if there's got spare cash, and they would like to invest. And the investment is either in the stock market or real estate. And now real estate has found flavor. People have seen growth. And of course, they've seen huge growth even in the stock market. So it's a trade-off, and where the money goes is another thing. But ultimately, everybody would like to have a home. And everybody would definitely like to, sort of, if they've got the first home, maybe upgrade to the second home. And of course, we used to do strata sales of office. Now that's sort of tapered off. We're not doing it anymore because it's a lot of management that goes into it, a lot of executive time that we have to spend when we do strata sales. So rather completely...
Mr. Razak?
Yes.
Sorry, I don't mean to interrupt you, but since you were talking a little bit about the office space, commercial space, etc., What have you made of the new SEZ rule that has been put in place? And I want to understand what is the percentage of commercial real estate assets that you have in this SEZ space, and what would the impact be?
Now, the impact will be very positive because SEZ had sort of tapered off, and many companies wanted to operate out of the SEZ spaces. There were many buildings that were ready and that couldn't be occupied only because they were SEZ, and there were many users who were non-SEZ. So by this rule change, you just pay back the duty, and this rule change will bring in a positive effect for commercial real estate. A lot more space will get unlocked, and people will be able to occupy these spaces, and then the vacancy levels will drop. So that's a very positive move. I think government also understood that and realized it. And there's no loss to the government. Basically, all the taxes that duty, the benefit that the developer had taken has to be paid back. So it's a win-win for all. It's a win to the developer, win to the government, and I think positively, the thing is that the spaces will be used unnecessarily instead of lying vacant.
Okay. All right, Mr. Razak, we'll let you go on that note. Thank you so much for joining us. And, speaking to CNBC-TV18, you've been a star performer this year, both in the stock market and outside. So hope you continue to create wealth for your shareholders and provide, great homes for all your consumers as well. Thank you so much for joining us, and Happy New Year to you once again.
Happy New Year to all the viewers, and we hope that 25 brings in more cheer.
Okay. All right, sir. Thanks a lot for that. Let's move on. Let's focus to the banking space now. Krishnan ASV, the lead analyst BFSI at HDFC Securities, joins us now with his call on the banking sector. Krishnan, hi, good morning, and thanks for joining in. First, the immediate news flow that came through, right? SBI hiking lending rates on most tenures by 5 to 10 basis points. What kind of impact do you see because of this? And in general, how are you feeling about PSU banks like SBI?
Hi, Sonia. Very good morning, everyone. Very good morning to your viewers as well. Look, I think this is just a continuation of the transmission that's got to play out for the rest of the system as well. So purely in terms of what they have done now, and it reflects the kind of liquidity environment we are in. You saw what the RBI said in its last monetary policy as well. They want to continue with withdrawal of accommodation. So I think we'll remain in a tight liquidity space. It's still a scramble for deposits. And obviously, when the largest bank does this, and, obviously it has got a transmission effect on the lending side as well. Yeah. So that's on SBI. PSU banks in general, we on a no-name basis, PSU banks are generally comfortable, at least as far as loan deposit ratios are concerned. But having said that, I think many of them may need to shore up their capital in light of risk weight increases that have come through now. So.
Okay. Now everyone's talking about banks coming back in a big way, right, in terms of stock performance. So ICICI Bank, IndusInd Bank are all at fresh 52-week highs. But for the private sector particularly, what's your call? Do you see more upsides? And, in terms of earnings, etc., what are you penciling in?
Right. So I think given that we were in a relatively easy environment for about a year and a half post the pandemic, that allowed almost everyone to flourish. Now things are a little tighter. We believe it's more beneficial for the larger entities, larger deposit franchises, that's banks and large NBFCs. I think they are likely to emerge stronger after this storm passes. And there will be a storm. I don't think this is just going to be just going to be lip service from the RBI. I think they want to see a material deceleration in growth. That will take a toll on the fringe players, on the marginal players. And so the competitive intensity should reduce. Ideally, that means good things for the larger lenders. We were generally conservative on loan growth, even pre-November. We felt that loan growth cannot be running too far ahead of deposit growth. So we believe that the jaw needs to be far more conservative. And so our numbers haven't undergone any material changes from a loan growth perspective. But what will happen is the competitive intensity now reducing probably means a few good things in terms of pricing environment, etc. So Purely from an earnings standpoint, I think there is still a little more lever available there. Having said that, I think the large cap names like ICICI Bank, etc., are the only ones where we see margin of safety now. Most of the other mid-sized players, NBFCs, we are stretching our assumptions a lot more. So.
You know, if we start rate cuts, right, starting with Fed and maybe RBI, etc. Say, for example, something like an HDFC Bank, I'm bringing that name up because it's been discussed so much everywhere. On the retail side, I think a lot of the book is on fixed basis. So on the way up, they suffer, but on the way down, they actually may benefit as compared to the others. Just your thoughts, Krishnan.
Hi, Prashant. I'm not sure which bank.
HDFC Bank. HDFC Bank.
Oh, no. That's a parent bank. I don't think I wouldn't comment.
Okay, yeah. Okay. No, I mean, I thought, but broadly, do you think, I mean, what does it do to net interest margins across the board?
Should get better, provided there is transmission. Obviously, SBI has led the way here, but, you know, on NBFCs, obviously, all of this was meant to ensure that the largest NBFCs, you are able to get some pricing power there as a bank. But it's not that easy in this environment to be able to, for an SBI to pass it on to a Bajaj or a Chola may not be that easy, right? So, of course, you can do some of these nominal changes, but, you know, we are still to see effect of whether or evidence of whether the transmission or say pricing power on the asset side is actually playing out. We will hold our breath there. We are not so sure it's going to play out that easy.
All right.
So yes,
Krishnan,
yeah.
Yes, go ahead. Finish your point.
No, I'm good. Please go ahead.
Okay. All right. Thank you for joining us. And speaking to CNBC-TV18. Have a great weekend. We'll slip into a quick break. On the other side of the break, KEI Industries is the stock we're going to talk about. Anil Gupta of the company will join in to talk about their business outlook. Later, we'll connect with Suresh Sethi of Protan eGov Technologies to talk about their incorporation of a new subsidiary and what the plan is in their business. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, let's talk about KEI Industries. The stock has been a big outperformer this year. It's up close to around 100%. Quarter two, well, it was good in terms of growth. The cable segment is driving their revenues, while margins also expanded. Mr. Anil Gupta, the chairman and managing director of the company, joins us on the show. Hi, Mr. Gupta. Well, your shareholders would be very, very happy looking at the stock performance in this year. But let's understand a couple of fundamental aspects. First up, in terms of demand, how is demand on ground? And if you could tell us, what are your current utilization levels in both your verticals, that's in the cables as well as in the wires business? Any kind of pullback on buyers?
Good morning. There's a very strong demand in the cable side. We are booked in all our cable segments, and in the wire segment also the growth is good, but it could be better. and I think it is improving, month after month. Secondly, so far as capacity utilization is concerned, we are operating around 95 to 98% capacity utilization in cables and close to 70% in wires and flexibles. So, but we are debottlenecking our plants at the moment and trying to improve the cable capacity by close to 10% in next 3 months.
Got it. All right. Mr. Gupta, earlier you had given us this guidance, I think, that you're looking to grow by around 16 to around 18%. And I think margins you were guiding in that vicinity of around 10.5 to around 11%. So do you expect this mid-teen growth to continue both for FY24 as well as FY25? And is there an upside risk to these margins?
I think whatever guidance we have given about the margins as well as the growth, both will be maintained. In fact, we are almost heading towards close to 11% EBITDA. And also the growth will be definitely around 18% in this financial year. And going forward in FY25 also, we are likely to maintain this growth. And not likely, but we are sure that we will be able to maintain this growth.
Okay. I just want to go back to that statement you made, Mr. Gupta, on the wires business. You said growth is good in the wires business, but it could get better. Can you just explain to us? Because if you look at the wire business in the quarter gone by, right? I mean, there's actually been a degrowth on your top line of about 3.5%. So when you say growth is good, what is your indication? I mean, do you think it can move to double-digit growth in the quarters to come? Just some numbers, ballpark, in the wires business.
We are expected to grow by close to 20% in volumes in wires and flexibles. Maybe it could be price maybe due to which in some quarter you may see the degrowth. But in volume terms, I think every quarter we have grown in this year also, and we are expecting overall 20% growth in volume terms in this whole financial year.
FY24, correct? Mr. Gupta, so this 20% growth in volumes is in FY24 for wires.
Correct.
Okay,
but,
and any early...
You were just showing stainless steel wire. Actually, stainless steel wire is a small unit operating within the company, and we have not increased its capacity for many years now. And the unit is performing well. But the turnover is fallen because of the substantial decrease in the metal prices from last year, and due to which, but in terms of volumes in tonnage, we have grown by 5 to 6%.
So across the board, what would the increase be in capacity over the next 1 year? How much are you looking to pump in, and what would it take the capacity to across all segments?
We expect to grow the capacity by around 15% in next 4 months in our existing plants. And next year, as we are undertaking a large capex, so next year, this year capex is around 500 crore, and next year also it will see around 500 crore capex. So next year we expect to increase our capacity by close to 10%. But in FY26, there will be a substantial new capacity coming up in our new plant coming up at Sanand near Ahmedabad.
And you told us about that to be completed in 2.5, 3 years, right? Mr. Gupta, good morning. Just to clarify, in the next 4 months, this additional 15% capacity is coming up for the cables business, where you're already at 95% utilization, right?
Correct.
Okay. In terms of the extra high voltage segment, I mean, in Q2, that provided the big pop in terms of earnings. How is that doing now, and what are you seeing there through the rest of the year and for FY25 as well?
It's doing well, and you will see the growth, a similar growth traction in this quarter also and next quarter also. And FY25 also, we are bullish that we will be able to maintain this quantum.
So EHV will do around 500 crores this year, and next year how much will it do?
Similar amount of production.
So it'll be so from 500 goes to 600 crores, 700 crores. What is the target? EHV.
both anywhere between 500 to 600 crore, depending on the order book is there, but depending on the clearances from the customers.
Okay, sir, always nice chatting with you. Thank you for taking the time out and speaking to us. Your stock has been a big mover this year, so congratulations on that, and hopefully the next year will be even better. That's KER Industries. It's doubled in 2023. It's been a star of this calendar year. But let's move on. Protan eGov is the company on our radar. Now, as we know, this company implements digital public infrastructure services. So they are a leading PAN service provider as well. They have incorporated a subsidiary in UAE as a holding company for their international business. To discuss more on this development and other business opportunities, we have Suresh Sethi, who's the MD and CEO at Protan eGov Technologies, joining us. Suresh, thanks a lot for joining in. You know, I want to first ask you about the business growth. The first half of the year, you saw your revenues grow at about 36%. What is the expectation in terms of the second half? Do you think you can maintain this kind of trajectory? And what are we looking at for the full year? Suresh, I think you're on mute. If you can just unmute yourself.
Yeah, good morning and thanks for having me here. From a business perspective and the growth that we have seen in the first half of the year versus last year, we clearly see that digitization and increasing adoption of digital services is what is propelling the growth for us. So while, as you mentioned, there have been strong growth factors of 36% compared to last year in the same period, we clearly see that all our underlying business drivers are growing strongly. Be it on PAN, be it on pension services or the ID services, and we expect the momentum to continue for the rest of the year.
Okay, so any numbers you can share?
We don't have any projections to share at this stage, but yeah, the underlying business drivers continue to grow strongly. And as I said, it's a larger macro phenomena linked to Digital India and the growth as such, which is coming out of there. And this is clearly all indicative and correlated.
Okay. On the margin front, there's been some amount of pressure. Can you explain that to us? Because this time your margins fell to about 20%, but you used to enjoy 22% margins last year. What are the pressure points now and what's the expectation by the full year?
So what we have done over the period of last 2 to 3 years, we've expanded into new lines of business. While the company historically has been strong in creating e-governance platforms, providing digital identity to the consumers, we are parallelly getting into empowering digitization of enterprises where we are building the data stack and digital onboarding services. And we've launched a new API marketplace in that space. So there has been a significant investment in people and in resources who are now creating open source protocols and technologies within the organization, full stack engineers. So part of the margin pressure has been because there has been a one-time investment in expanding teams to cater to the new lines of business. But we expect these to give us the returns as we go forward.
All right. Hi, Mr. Sethi. Good morning, and thanks so much for joining in. This is Nigel on this side. A couple of quick questions. One is, you've incorporated a unit in UAE. What's the game plan out there? And also, you've made an investment of around 15 crores in ONDC. So tell us the plan out there as well.
So Nigel, clearly, as I mentioned, we are in the space of creating digital public infrastructure. And as a company, we moved beyond BFSI. Our earlier assets were in the space of taxation and pension. And now we are looking at a multi-sectoral DPI contribution across digital commerce, across areas like mobility, health, agriculture, and education. As we look at the DPI adoption in India and our proficiency in that, we are looking at taking the same across to global markets, especially developing countries which are at the cusp of looking at creation of digital infrastructure at the foundational level. Our subsidiary in the UAE is a direction in that step. We are putting up a holding company over there, which will help us to create operating units in multiple countries, especially across the developing markets. With regard to ONDC, it has again been a strategic investment for us. As you know, we are contributing and powering some of the building blocks on which ONDC or the digital commerce ecosystem is running. And for us, it's a strategic investment into the network facilitator who is governing and building the entire network in that regard.
So how much would you own now in ONDC? Mr. Sethi, morning, Prashant here.
Yeah, Prashant, morning. So we have a 5.56% holding in the ONDC cap table as of now.
Okay, all right. Just a quick point. A lot of these deals, right, when you are able to go to other markets through this UAE subsidiary, this would be done government to government, and then you sort of, Protein would be roped in to execute? Or no, I mean, you go and pitch. I mean, how does this work?
So, Prashant, there are multiple aspects over there. Actually, it's a bit more, I would say, detailed. A lot of these countries today need a lot of advocacy and understanding of how digital public infrastructure needs to be created. And we are, engaging at advocacy and knowledge sharing level. And then you are right, there could be, again, multiple options. It could be multilateral funding. It could be country-to-country funding. So in each case, the association differs. But yeah, at a digital infrastructure level, these are mostly government-driven, and therefore our basis government issuing tenders in this regard.
Just one last question from my side. For the local business, right, what is the market opportunity? Digital public infrastructure, I mean, I think we are the best in the world. I mean, India, in terms of the reach, in terms of penetration, has done fantastically well to push that, and you've been a part of it. But, and there'll be new things like ONDC, and, there'll be more rails, digital rails built. But as you see right now, what's the total opportunity? I mean, if you can put a number to it, where you can kind of bid and participate to get a piece of the pie?
So, Prashant, one is our traditional businesses. Again, there are definitely headroom over there. I'll quickly take 2 minutes on that. So on PAN and pension, again, there is significant, pension is an underpenetrated society for us. So today we have around 6 crore accounts put together between NPS and Atal Pension Yojana, and huge opportunity to further grow that business. PAN, again, is not a saturation ID, so you only get it as you come into working stage in your life, or you open your first bank account. And therefore, again, a huge ability to issue more PANs every year, year on year. But coming to the new DPIs, if we look at areas like ONDC, digital commerce penetration in the country today is hardly in low single digits. We are talking about 4 to 5%. And interventions like ONDC are significantly going to open that entire ecosystem. And there are market projections to say there could be a 5 times growth in penetration by the year 2030. So as we are providing services at the infra level, which is more at the building block level, plus we are providing services to power the enterprises which come onto these ecosystems, we see a double growth coming from both of those areas into our business lines.
All right. Well, we'll end it on that note. Thank you for giving us a quick snapshot on your business. We'll slip into a quick break on that note. The market, by the way, is piling on those gains. So 21,300 is here. When we come back, Mitesh Chakkar will join in for some technical trades. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Okay, welcome back. The market up 130 points, 21,300 on the index. We're at the day's high. Mitesh is with us with what to do now. Mitesh, good morning. On the index, what should one do? If you're holding longs, I guess hold on. But on stocks, what's the recommendation?
Yeah. So I think, Prashant, there is no doubt in that. I think if you're holding long, hold on. And you can just trade your stop loss to about 21,180 on the spot, which is roughly about 130 odd points lower. But then, the idea is that you would want to ride as much as possible on the upside. So give some, space for fluctuations to happen. And on the stock side, Commodities is a buy. Keep a stop at about 145 half levels and look for a 155 kind of a target. And the other one which I like is Aarti Industries, which I would recommend buying with a stop below levels of 574 for targets of 610.
The industries is what you like. Got it. By the way, all these fertilizer companies are seeing big moves right now. FACT is up almost 9%. So that both on the volume and the price charts is looking very good. And specialty chemicals is coming back. So alkyl amines is also up about 4%. But let's get going into the commodity space now. Manisha Gupta is here to tell us what she's tracking. Manisha, good morning. What are you looking at?
Well, I'm looking at metals as a sector because while this week has been choppy, but we are headed for a weekly gain for most of the metal prices, whether it's precious metals or industrial metals for that matter. The trend has improved, especially on the back of Fed signaling 3 rate cuts in 2024, and that has been positive. It also has to do with the US dollar index, which is trading at near 4-month lows. That has led to many of these dollar-denominated commodities trading on the higher side. The Chinese data and a lot of that has come in today, but that is mixed at best. The recovery is uneven, and the street is still waiting for more stimulus measures to come in from this sector. But even then, when you stack up the data, China continues to be one of the major consumers for many of those metals there. The metals also have been taking some strength for the last couple of weeks now on the back of mine closures, whether it has been in Peru, Mexico, even Australia. And the disruptions is something that is adding to support in many of those prices there. And then apart from that, it also has to do with energy transition and underbought positions from funds who would want to get in metals at these lucrative levels is something that could be supportive as well. I want to start with gold and silver because that one is trading at a 1-week highs. We are looking at strong gains on that. Zinc has been an underperformer for the last couple of weeks, but that also is trading off the 3-month lows, and we have seen prices gain above $2,500 a ton there. Aluminum is the other one, and that rebound here has been actually the smartest. Overnight, we've seen 3% of gains come in for aluminum. That is coming off its 14-month lows as well. There is statements from Norsk Hydro saying that it has been about weak demand from industry, vehicles and manufacturing. That did lead to sales down by 57% in third quarter, but fourth quarter seems to be stabilizing as it was. Also, markets are looking at the China's October import when it comes to aluminum, and that has seen a gain of nearly 10% in the month of October on a year-on-year basis there. Markets also are looking at support for palladium prices, rebound from 5-year lows onto that one. Platinum is trading at a 12-week highs. Copper prices trading near a 4-month highs as well on the back of supply concerns in Peru and Panama. So good day and good week really for the metal prices there. The chart should tell you on what we've done on a overnight and a week-on-week basis then. So as you can see, the overnight market has been really grand. 2 to 3.5% of gains is what we've seen across board. And on a week-on-week basis, this is the last 1 week actually. Aluminum, platinum clearly outperforming with 4 to 5% of gains. Zinc, copper also in the positive. Gold and silver prices, and that should come in on your screens because gold also has performed quite strongly. 2% of gains in this week with silver coming in also on the stronger side.
All right, thanks a lot, Manisha, for that. Well, moving on, FarmEasy has raised close to 4,000 crores from its rights issue, with 1,300 crores being subscribed by Ranjan Pai. We caught up with Siddharth Shah, the founder and CEO of FarmEasy, to discuss about their rights issue and also how he plans to reduce Thyrocare's 100% promoter pledge. Listen in.
Subscription of the rights issue is now in fact a little north of 3,950 crores, which in a lot of ways I think is a big testament of support for what we are doing and the belief that ultimately we can literally become the best player in digital healthcare in India. Mr. Pai had made a commitment to subscribe to 1,300 crores as part of this round. But given that it's oversubscribed, I think we're all figuring out how much of an allocation will Mr. Pai get, how much some of the other investors get, because it was very clear from the way our rights issue was structured that the first right of infusing capital will come indeed to our existing shareholders. And the balance will go to Dr. Pai, but I think we'll figure out a way where Dr. Pai also gets a chance to participate. And in fact, he's been very, very supportive, right? And one of the big reasons for helping us get here. When the debt gets repaid, that will get away. We have reasonable or more cash cover. So what we're doing is Goldman's money was taken through issue of NCDs, which were in two different bonds. One bond gets repaid immediately, the other bond gets repaid within 12 months, right, ideally. So we're figuring those details out, but upon full repayment of the bonds, the pledge goes away.
In fact, catch the entire interview on Halftime Report that comes up today at noon, so do stay tuned in for that. Let's take a quick break on that note. On the other side of the break, Lata will connect with Jahangir Aziz of JP Morgan and Steve Englander of Standard Chartered on the Fed's unexpected pivot yesterday and what it means to India and emerging economies. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome to It's the Economy. The Fed stunned all of us and unleashed a huge rally in stocks and in bond markets globally when it announced that it might cut 3 times and not twice next year. Also, a very dovish Jerome Powell press conference. To analyze what this means to India, emerging markets, I have with me Jahangir Aziz, global head of EM economies at JP Morgan, and Stephen Englander, the global head of G10 FX research and North America macro strategy at Standard Chartered, both joining us from the United States. So thank you, gentlemen, very much for staying up for us. Jahangir, first, what's the message from the Fed? And is it clearly looking at a soft landing for the US next year?
So I think that's where the puzzle is, Lata. I think, if you look at the FOMC, both the FOMC statement as well as the press conference, clearly there has been a pivot that has taken place, right? The pivot has been in 3 different ways. One is that, in terms of, instead of talking about whether additional tightening is necessary, the bar has been raised much higher by adding the word any, whether any additional tightening is necessary. So I think that was the first, turn from what we had seen, what we have heard before. But I think much more important was the idea that you no longer require the economy to be growing below trend in order for inflation to come down. So if you think about, what has happened to the disinflation process in the US, I would say about, 2/3 of the disinflation that has happened largely because of, normalization of pandemic-related disruptions, whether that is related to China or whether that's related to the disruptions in US's own domestic labor markets. That has been the key driver of inflation. And I think at this point in time, with the change in language, I think the FOMC believes that the remaining 1/3, so getting inflation to that 2.5% level, that can actually be achieved without having to push the economy to below trend growth. And I think that's a big shift that's taken place. And I think the third bit, which I think, probably, not hasn't really been that well, discussed in the markets commentary that came out of that, is the fact that, the Fed is talking in terms of whether or not, the stance already is too restrictive, because there was clearly no pushback, whether in the statement or in the press conference, to the argument that financial conditions have eased significantly, and there was no pushback. Think about, just the last FOMC, where the Fed was really concerned that, about what has happened to financial conditions, and we're looking closely to it. So clearly there's been a pivot. Now, answer to your question, do we actually see on the ground the data breaking in a direction that decisively is telling us whether or not there is a soft landing? I think that hasn't been the case so far. You have seen inflation prints in the 0.2 range. PCE has been running a bit higher than that. But look at non-farm payrolls, look at what's happened to PMI and IP. So I would say that we are still in this, world in which I would say that the data is, quote unquote, observationally equivalent to a soft landing and to a hard landing. But clearly, at least the FOMC feels that the soft landing is probably the baseline that they're working on at this point in time.
Okay. Well, let me just come to growth. How does 2024 pan out in terms of growth? Will it be, for the US economy, will it be a year of decent growth?
So again, that's where you run into an issue, right? So let's say when we talk about, when will the Fed cut rates, right? So clearly, if the financial conditions are not harming growth, then the Fed is in no hurry to cut rates. And therefore, the Fed can stay on hold for a prolonged period of time. We are in that camp, and we're looking at June to be the time when we have a first rate cut. So that's your decent growth. That if there is decent growth, if non-farm payrolls average at that 150, 200, which is what's been averaging over the last 3-4 months, the economy doesn't break down, then the Fed is in no hurry to cut rates. On the other hand, you really require the data to start cracking, particularly in the labor market, for the Fed to come and start, a much earlier rate cut. So I think that, as far as, the soft landing scenario is concerned, you do need the US to slow down and slow down quite a bit in order for you to deliver that 2% growth rate. Clearly, the slowdown doesn't have to be below trend, but you still need a slowdown from the 4.9% third quarter print. If you have a 4.9% third quarter print, Lata, I think you will find it very hard for people to start believing that there is actually a soft landing in the making. So you need 4.9 to slow down. But I would say that by and large, somewhat below par or below trend growth or around trend growth is probably consistent with inflation coming down if the supply side is going to cooperate, and which is clearly where most of the disinflation that has come has been from the supply side, not from a breaking in the demand side. And I think that sort of is the faith on which the FOMC is working on. That's broadly what our baseline also is. So we do have a soft landing where the economy slows down, labor market slows down but doesn't crack, and then you get to that 2.5% level for a sustained period of time, and the Fed starts cutting in June onwards.
June, okay. That Stephen, thank you for your patience, and that's exactly my question to you. How many Fed cuts are you pricing in, and when does it start?
Well, we haven't changed our forecast, which we made some time ago, of 2 cuts beginning in Q3. But obviously the change in Fed sentiment makes a big difference. What worries us a little bit is that the data haven't changed that much from 2 weeks ago or even 2 months ago in terms of showing a slightly softish U.S. economy, a gradual slowing in inflation. But the way the Fed is looking at the data has changed a lot. So we'd like to see some confirmation that the economy is slowing as well. But, obviously the risk is that they move a lot quicker than, what the market had been expecting and, what we have down as our baseline.
Okay. And how much can bond yields fall? They've fallen quite a bit, below 4%. Will the fiscal deficit and this huge supply of bonds be a threat to the bond market?
Well, the fiscal is a threat, and medium-term inflation issues are a threat. And obviously the momentum is to the downside now, and breaking 4%, and technical factors could take it down lower. We're just skeptical that it's going to stay here over the medium term. We think that the market was really surprised, it was caught offside. The sentiment had been a little bit hawkish going into the FOMC, that they would repeat what they had said in comments before the quiet period and at the previous FOMC, and they sort of came down very, very devishly, and the market is reacting to it. Whether we stay here over the longer term, I think, is the bigger question.
Okay. Yes, that's the big question. And what about the dollar? The dollar also has given up a bit. Where is it headed, and what's the range for the dollar index?
We think it will fall and fall some more, but we think it's done a lot of the falling already, that a lot of what we had anticipated happening later in 2024 has already happened. And, it would take a lot, I think, to get the market to really start pricing in an even more aggressive Fed. It could happen if the economic data collapsed. But if say the unemployment rate stayed stable in January when it gets released, and some retail sales were pretty firm today. The run rate for GDP is around 2.5%. You keep getting that kind of data. It's not clear that the market will continue to be as optimistic that the Fed is going to cut soon and cut hard.
Okay. Yeah, of course. Now, just a word on the rupee. Do you see more appreciation on the rupee because of the huge equity and bond flows?
I think this is a very good scenario for high-yielding currencies, because often when you're in a Fed hiking cycle, or when there's ambiguity about which way the Fed is going to go, the extra yield is viewed as risk premium. Now that the risk seems to be that the Fed is cutting rates, they're certainly not raising rates. I think the market sees that that extra yield as real yield, and high yielders, and rupee among them, become very attractive. So we could see a lot of capital inflows, not just into India, but into other emerging markets.
Okay, stay on. Jahangir, let me get you in on India. Reserve Bank had already upped its growth forecast to 7% even before the Fed. Now with the Fed taking its feet off the brakes, isn't the combo very good for India?
So I would say clearly, if global financial conditions are going to ease, whether they are going to ease because the Fed actually cuts rate, or whether it's easing because the market is anticipating that the Fed is going to cut rates, there has clearly been a decisive shift in financial conditions globally from what it was even about 3-4 weeks back, right?
Yeah.
So clearly that bodes extremely well for India. It bodes extremely well for all emerging market countries. I think the resilience that has been shown by emerging market countries, not just in 2023, but also in 2022, having been able to navigate, one global shock after another global shock, and still standing tall in December of 2023, speaks very strongly about the underlying resilience of emerging markets. If you take that resilience on one hand, Lata, and the fact that clearly no one really has any emerging market assets on their books, because look at the capital flows. The capital flows, even I look at November, is barely back to what used to be the case prior to the pandemic, and it's nowhere close to the kind of capital flows that we saw prior to the taper tantrum. So there hasn't really been any real holding of emerging market assets. So if you have that low ownership of emerging market assets on one hand, you get the resilience, and then you add on to it that the US will have a soft landing, and that soft landing will give you 100 to 125 basis points of rate cut whenever it happens in 24. It doesn't really matter the timing of it, but that is going to happen. Then I think this is going to be one of the strongest years emerging market has seen in a long, long time.
Okay, good to hear. Jahangir, when does RBI cut rates?
So I think that the RBI, just like the other Asian banks, is going to actually wait. Unlike the Latin American banks, which have already started to cut rates, or the Central European central banks that have already started to cut rates, they are going to keep on cutting rates. They're going to cut rates with a little bit more of comfort and relief that the financial conditions globally is not going to go against them and raise concerns about financial stability. But I think the Asian central banks, including India, Indonesia, Bank of Thailand, BSP, and Bank of Korea, they are going to wait. They are not going to preempt the Fed and start cutting rates earlier, simply because they have very little margin over the Fed funds rate. And if something goes wrong, and think about it, Lata, I mean, this time last year, we were talking about a recession in the first half of 2023, and instead in January, we got a non-farm payroll of 350,000. That completely and totally threw all of us. So things can happen, right? Look, just because we've got 2-3 months of very, very, very good inflation prints in the US does not mean that the January and the February numbers won't turn the other direction. So I think that the central banks in Asia, RBI particularly, is going to wait. They're going to wait and see whether the Fed actually starts cutting rate, and whether this is the beginning of a reasonably large easing cycle. I think that's when they will cut rates. So I don't expect the RBI or any of the Asian central banks to cut rates in the first half of the year. They're going to wait till the Fed